The unilateral action of the world's largest oil exporter poses challenges to the market. Cutting oil production by Saudi Arabia, the largest oil exporter globally, cannot rescue the weakening oil prices. For the second consecutive month, Saudi Arabia, the leading producer of the Organization of the Petroleum Exporting Countries, OPEC, has voluntarily extended the oil production cuts by 1 million barrels per day for an additional month, this time until August. The cuts will bring Saudi Arabia's production down to nearly 9 million barrels per day, the lowest level in several years. Saudi Arabia has made sacrifices by reducing its output to stabilize the declining oil prices, but so far, it has had limited success. Immediate response in the oil market has been positive, with WTI crude oil prices increasing by 2.1% to $71.25 per barrel at 11:45 Eastern Time on July 3, while Brent crude oil prices rose by 2.0% to $76.15 per barrel. However, oil traders remain unconvinced. Marwan Yunus, the investment director at Masser Capital Management, stated that profits might only be short-lived. The issue is that when you cut production in an already weak environment, the impact will be limited, said Ole Hansen, head of commodity strategy at Saxo Bank, to the Wall Street Journal. Last month, Wall Street maintained a bearish sentiment after Saudi Arabia announced the first extension of production cuts. Goldman Sachs oil super bull, Jeff Currie, once again lowered his forecast for December Brent crude oil prices, this time to $86 per barrel from the previous range of $95 to $100. Currie explained the downward revision due to increasing supply from Russia, Iran, and Venezuela, along with growing concerns of a global economic downturn. Analysts at Citibank also expressed pessimism, stating that Saudi Arabia's cuts are unlikely to sustain oil prices at $80 or $90 due to weak demand and stronger non-OPEC supply later in the year. The bankruptcy of Silicon Valley Bank, SVB, in the United States in March triggered a massive capital outflow from oil to precious metals as widespread anxiety and fear grew that this could be the early stages of a financial and banking crisis. According to commodity analysts at Standard Chartered, SVB's collapse led to an unprecedented short-selling trend in the oil market, with speculative short positions 6 times larger than after the collapse of Lehman Brothers and Bear Stearns in 2008. As predicted, oil prices hit multi-year lows just a few days before starting a partial recovery due to the voluntary production cuts by some OPEC Plus members on April 2. However, not everyone is pessimistic. According to the International Energy Agency, IEA, global oil consumption is still on track to increase by 2 million barrels per day this year, reaching a record high of 101.9 million barrels per day. Inventory levels are gradually tightening and will continue to deplete as OPEC Plus implements further production cuts. Crude oil inventories fell below the 5-year average for the first time this year. Last week, gasoline demand increased by 992,000 barrels per day, reaching the highest level in 15 months at 9.511 million barrels per day. Standard Chartered Bank predicts that OPEC Plus' final cuts will eliminate the accumulated surplus in the global oil market over the past few months. According to analysts, a significant surplus began forming in late 2022 and into the first quarter of 2023. It is estimated that current oil inventories are over 200 million barrels higher than at the beginning of 2022 and over 268 million barrels higher than the minimum level in June 2022. However, analysts are optimistic that the surplus from the past 2 quarters will dissipate by November if the cuts are maintained throughout the year. In a slightly less optimistic scenario, a similar outcome could be achieved by the end of the year if the current cuts are reversed around October, leading to a price increase in oil.